Fundamentals webinar number 2. This one's entitled Financial Information for Decision Making. And I welcome everyone. My name is Philip Blackerby. I'm a consultant with ADOT's Business Engagement and Compliance Office. I've worked with many DBEs over the last several years, mostly in financial management, strategic planning, and marketing. I've worked with over 800 entrepreneurs, mostly in the greater Phoenix area, and primarily with training. I have degrees from the University of Texas, Hook'em Horns, and Brown University. So today we're going to talk about how to make better decisions as a result of having your financial information. The key question is, how much sales do you need every month before you break even? I think that would be a good question to be able to answer. How to manage your suppliers who want money right away, how to manage your customers who want to pay you later, and how to project and manage your cash flow so you don't run out of money. Don't run out of money is a key element. But first, we're going to do a quick review of last month's webinar. And we started with the rules to live by. Kick Droom, everybody can remember, Kick Droom. So what does that stand for? Kick is cash is king. Cash is the fuel that actually runs your company, and just like when your car runs out of gas, your car stops, so that when your business runs out of cash, so does your business stop. Droom, on the other hand, is don't run out of money, and this is a key element here. So don't stack up on a bunch of overhead, incur no overhead before it's time, as they say. And this is one of the top 3 jobs that a CEO cannot delegate. This is the CEO's responsibility all the time. Now, there are 3 basic financial statements, and we're going to talk about the balance sheet and the P&L, or income statement, profit and loss statement. There is a third one, the cash flow statement, but we're really not going to talk much about that because most of you are on a cash basis of accounting rather than accrual-based. So this is our balance sheet. A couple of key items here. First of all, it has an as-of date. It's like a photograph of your business, and it only affects that one moment. On the left side is the assets. That's what I own. Cash and equivalents, accounts receivable, other short-term. Those are your total assets. Your inventory, plant and equipment, less the accumulated depreciation. You may have other long-term assets. Assets are pretty clear. On the other side is liabilities, what I owe. So assets are what I own, O-W-N. Liabilities are what I owe, O-W-E. That includes accounts payable, short-term debts, long-term debts. Those are the total liabilities. There's a third category that goes on your balance sheet called equity. Equity has 2 primary components, investors' capital, retained earnings. Retained earnings are the amount of money, the profits that you've earned in the past that you've left in the business. If you took a draw or a dividend or any kind of taking money out of the company, then those retained earnings decrease. That gives you total equity. Now, when you add the total liabilities plus the total equity, you get liabilities and equity. And what's important about the balance sheet is that the assets equal the total liabilities and equity. There's the basic accounting formula, A equals L plus E. Assets always equals liability plus equity. Last month we ran through a couple of examples to show how that works. We won't do that now, but take it from me, assets always equal liabilities plus equity. Now, there are 2 intangible assets that do not show up on your balance sheet. Those are intellectual property, such as know-how, and brand value, or goodwill, which is know-who. So this is your reputation. It's important to protect these intangible assets, just like we protect our other assets. We have insurance on our bank accounts. We have insurance on our automobiles and trucks. We have virus protection on our computers. So we protect our cash and our equipment. And just like we protect those assets, we need to protect our intellectual property with copyrights or patents or trade secrets, and we need to protect our brand value, our reputation in the marketplace. If these assets did show up on our balance sheet, then we would balance them with equity. So we maintain assets equals liability plus equity at all times. Now this is our P&L, also called income statement. If you hear P&L or income statement, those are exactly the same things. And the first item that we want to recognize is that this has two dates, a from and a to date. So there's always a range of dates that the P&L covers, typically January 1 to January 31st, January 1 to March 31st, January 1 to December 31st, month, quarter, year. Now when we look at the P&L, we notice the top line is gross sales. That's an important thing. Then we have cost of goods sold or cost of services sold. Those are variable costs. They don't get incurred unless you actually have a sale. So this is the cost of materials and the cost of labor that goes into making the products or services that you sell on your gross sales. So you don't incur these costs in theory unless you actually have a sale. You subtract the cost of goods sold from the gross sales and you get what's called the gross profit. And we use the term, the symbol pi, the Greek letter pi, to represent the word profit. So your gross profit then is gross sales less cost of goods sold or cost of services sold. That gross profit generates a gross margin. So if you take your gross profit and you divide it by your gross sales, multiply it by 100 to make it a percentage, that's your gross margin. The gross margin that's appropriate depends on what industry you're in, but you know, we'll see what's valuable to you. Another word for that gross profit is contribution, because that's the money that's available to contribute to your fixed expenses or your fixed costs, which are the selling, general, and administrative costs. Now your QuickBooks doesn't recognize those selling, general, and administrative costs, but you can create a super category or 3 super categories in your QuickBooks for selling, general, and administrative costs, and make all of your other expense categories subcategories of those 3. So the selling includes all your marketing expenses, advertising, marketing, base salaries for your salespeople. Your general expenses, that's what's generally considered overhead, so it's rent, utilities, telephones, all those sorts of things. And then there are administrative expenses. These are your legal expenses, your accounting expenses, all the things that are about running the business as opposed to expenses that support serving clients and customers. There's also your operating profit. Then when you take your gross profit, subtract out the selling, general, and administrative expenses, you get the operating profit, also known as EBITDA. If you listen to David Faber on CNBC every morning, he's always talking about EBITDA. And so then you generate an operating margin, your operating profit divided by your gross sales times 100. And this is the number that tells you whether you're actually making any money in your operations of your business. Now, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So we need to add or subtract the interest, taxes, depreciation, and amortization from that operating profit to generate net profit. Net profit is the amount of money you actually put in your pocket. And so, of course, once we have a profit item here, then we have a net margin. So net profit divided by gross sales times 100 to make it a percentage is your net profit, your net margin, excuse me. So your net margin, that's the money that you actually earn. What percentage of your gross sales actually goes into your pocket? I said this is a quick review. We do have the third element of the third statement. For those of you who are on accrual basis, you will also have a cash flow statement because this reconciles your P&L back to your checkbook. If you are a cash basis company, which most of you are, then you won't need a cash flow statement because your checkbook is your cash flow statement. It also has a range of dates. And then there are really three different ways of thinking about your cash flow: sources and uses of cash due to operations, sources and uses of cash due to financing, and sources and uses of cash due to investing. And so that's one way to think about how you get money and how you use money, either through operations, through financing, or through investing. Now, we're really going to focus here on the break-even point. Profits increase with sales. So let's look at this basic graph. We have sales on the upper left, quantity on the lower right. The first thing we get here is fixed costs. So these are your SG&A, your sales, general, and administrative expenses. And it doesn't matter how big your sales are, you have the same level of fixed cost, regardless of how many sales you actually make. So that's a flat line right across because those are fixed costs. We then have variable costs. That's our cost of goods sold or cost of services sold, and they increase with your sales. So the higher your sales, the higher your variable costs. It's pretty straightforward. But we add then the variable cost to the fixed cost, so it raises that line all the way up to above the fixed cost. And that's our variable plus fixed cost. So they start at the level of your fixed costs, and then they go up as your sales increase. The next thing we're going to add to this chart then is your sales. Now, the key here is that your sales, of course, is the more you sell, the more money you get. And so your sales, though, is steeper than your variable plus your fixed cost because you're running a profitable business. And so right there in the middle, where the sales line crosses the purple variable plus fixed cost line, you have the break-even point. Right there where those two lines cross. Now what this break-even point means is that everything to the left of that break-even point, you're actually losing money. But as your sales increase, your losses get smaller and smaller and smaller. Everything to the right of that break-even point, you're in the profit. So you have to get a minimum level of sales in order to start generating a profit. And that break-even point defines where your losses turn into profits. So knowing that break-even point is very important. So the question is, how do we figure out what that break-even point is? Well, there's a formula. The formula is fixed costs divided by your gross margin. So let's remember our earlier discussion. Fixed cost, that's our SG&A. That's a dollar amount. We divide that by our gross margin, which is our gross profits divided by our gross sales, times 100 to make it a percentage. We don't need to multiply it by 100 here because it'll come out as a decimal. So let's look at this a little more in terms of an example. So our fixed costs, SG&A, divided by gross margin, that is gross profits divided by gross sales. So let's say our fixed costs are $10,000 a month. Our gross sales are $500,000 a month. It's a big business. Our cost of goods sold is $300,000 a month, and our gross profit then is 500 less 300 is $200,000 a month. So we take our gross profit divided by our gross sales. So 200,000 divided by 500,000 is 40%, or 0.4. So our fixed costs are $10,000 divided by 0.4, which is our gross margin, is $25,000. 10,000 divided by 0.4 is 25,000. You can do the arithmetic if you have a calculator, but that's the break-even point then. $25,000 in gross sales will cover our fixed costs, plus it will cover the variable costs needed to achieve that level of sales. So that's our break-even point. Whenever we sell more than $25,000 a month, we're going to break even. If we sell less than $25,000 a month, we're going to lose money. So knowing your break-even point is very useful, and that comes right out of your profit and loss statement. So that's an important statement for you to pay attention to, and everybody should know what your break-even point is. Now, your fixed costs and your gross margin may change from time to time, so you may need to recalculate that every once in a while to figure out what it is. Now, every small business that I know eventually gets into a cash flow squeeze. And this is real typical because most small businesses serve big company customers and they serve big company suppliers. They're kind of squeezed in the middle. All those customers have more market power than the small business does, and all of those big company suppliers have more market power. So the customers, they want to pay you in 45, 60, 90 days. You know, everybody's used to 30 days. Everybody thinks you can get paid in 30 days. But all those big companies, they really want to pay you in a longer period. They basically want to finance their business on your back. And then they start playing games. So I had a Fortune 500 company one time. I sent them a $600 invoice, just $600, and they said they would pay it in 30 days. So I get down to the 31st day, and I hadn't received the payment. I call them up, and I say, hey, I'm looking for a payment on that invoice. When are you going to send it? And the guy on the other end said, invoice? What invoice? I don't remember getting an invoice. Well, I know he got it. I'm sure it was on his desk. No question in my mind. But he said, why don't you send it again? So I send it again, and now they start the 30-day clock over again from scratch. This is a game. This is a game that these big companies play, and it's a way, it's partly how they got to be big companies. They manage their cash flow very carefully, and they don't care that they're financing their business on the backs of their suppliers. So as one of their suppliers, as they are your customer, you really got to manage that market power. So call them. Don't wait for the 30th day. Call them at day 20 or day 22 and say, hey, just want to make sure you got my invoice okay and that you're prepared to pay it within the 30 days. Nothing wrong with communications and keeping up with them, making sure that they know that you're paying attention to your cash flow. Now, your big company suppliers have kind of the opposite issue. They want you to pay on order or on delivery. Sometimes they want half of it on the order and the other half on delivery, or they want all of it on delivery. And if you don't pay everything on time, they may hit you with penalties, which you don't want to pay, by and large. Those penalties are very serious. So what can we do to try to mitigate this cash flow squeeze? Well, there's several things we can do. One is when we get a big company customer, we can ask for a deposit. Some of them may give us a deposit, some of them may not, depending on the size of the order. If it's a very large order and you're going to incur significant cost, then it's okay to ask for a deposit, and the worst they can do is say no. You can bill them in advance. I sometimes do this. I know a payment is due in the future on a certain date, so I'll bill it a couple of days early to make sure that they have time to process it and send me the payment. You can offer a discount for timely payment. Sometimes we see this 2% 10 net 30 is usually the term, which means if you pay me in 10 days, I'll give you a 2% discount. Otherwise, you pay the full amount within 30 days. I generally discourage people from using those discounts. 2% for a 20-day faster payment is an actual annual interest rate of about 35%, 35 or 36%. That's a lot of money to give away to some of your big company customers. You can use credit cards, and as long as you pay those credit cards off, usually within 23 or 25 days, then you don't really incur any interest, though the interest on a charge card can be very high, 25% on most of mine. If you have a really good credit rating, maybe you can get that interest rate lowered. Some customers are not worth having, and so if they're really bad customers, there are bad customers, they don't pay on time, then you should refer those customers to one of your competitors. This does two things for you. Number one, it gets them off of your back so that you don't have to finance their operations on a regular basis. And two, it puts them on the back of one of your competitors. That's not necessarily a bad thing. If a big company if your customer doesn't pay you, then you should stop services. Once an invoice is late, then, don't keep providing services to them. Don't get stacked up. I had a client who was a painter, and he had painted a house, and the guy didn't pay, and the painter kept on providing more services, kept on painting the house, still no payment. Eventually, the contractor went bankrupt, and the guy lost about $15,000. That was a real blow to his business. It was a small crew painting company. The other thing you can do is use a factor. A factor is somebody who basically will buy your accounts receivable. They'll buy it at a discount. So they'll give you the money early, and then they make an arrangement. You make an arrangement with your customer to pay the factor directly for when he issues the check. The factor will then discount, however, usually about 2 or 3%, depending on how long the factor has money out. Now that 2 or 3%, again, calculates out to an annual interest rate of about 35 or 36%. So factoring can get you your money earlier, but it becomes fairly expensive money to do that. So be careful. There are some instances where a factor is the right solution, but do recognize that it's a fairly expensive way of doing business. So those are just some of the strategies that you can use with those big company customers who don't want to pay you on time. Now, those big company suppliers, they do want your money immediately, and there's a few things you can do for them. You can ask for terms. So, again, the worst they can do is say no. Say, let me pay you this in 30 days. Maybe they'll do it. Maybe they won't. You can offer them a discount or ask them about a discount so that you don't have to pay it. If they offer you that 2% 10 net 30 deal, take it because you're earning effectively 35 or 36% on the payments on the money that you are discounting. So it's a good deal for you if it's offered by one of your suppliers. You can ask them to hold the check. We had a retail client who sent a check. She was selling blue jeans. And she would send a check to her blue jeans supplier and put a note on the check that says, please hold this for 2 weeks. Sometimes they do it, sometimes they wouldn't. But it always improved her cash flow when they did. You can charge your expenses to a credit card, and again, you get 25 or 23 days sometimes to pay that bill without incurring any interest. As long as you make those payments on time and don't have to pay that interest, that can be good. But that interest can be expensive if you incur it. Many businesses are able to secure a bank line of credit. A line of credit is basically allows you to write a check where you don't have enough money in your account. The line of credit will automatically cover the amount of your check and add to your borrowing from a bank. These are bank loans, effectively, where the amount of the loan can fluctuate from day to day, month to month, and every month you have to pay the interest on the bank loan, but you don't necessarily have to pay back the principal. It's a good idea to pay back that principal at least once a year, though, so that you know you get back to zero. So a bank line of credit, if you can get it, is good. Generally, you have to pledge collateral against that line of credit, which could be the assets of your company or your receivables. In theory, if you fail to pay your bank line of credit off, they can come seize your assets or seize your receivables. Another strategy is called the joint check. And sometimes the suppliers will do this. Basically, you execute a joint check agreement, and the suppliers and you execute the agreement along with your customer. And so when the customer then issues that payment, the customer makes the check out to both of you, both to your business and to your supplier. So it requires both of you to endorse that check in order to deposit it, which gives both of you leverage and makes sure that you both get your money. So the supplier will advance you the supplies that you need in a joint check and make sure that the supplier gets paid, because the supplier has to endorse the check in order for anybody to get any of their money. And this is covered, the joint check process is covered in our Financial Services Handbook, which we'll talk about a little bit later. Now I want to talk briefly about how we plan cash flows. This is one approach to planning cash flows. So if you see, we have on the far left a series of categories: beginning cash, our revenue, our cost of goods sold, our SG&A, those are our fixed cost expenses, our payroll, our interest, and that generates then a net cash flow. So revenue less cost of goods sold, less SG&A fixed cost, less payroll, less interest, that's our net cash flow. So we start with our beginning cash, subtract or add the net cash flow, and we get our ending cash. And then we have our credit line, our line of credit balance at the bottom. So let's see how this works. In the blue squares there, we have actual performance. So we start with 4 weeks ago, then 3 weeks ago, then 2 weeks ago, then last week. And then the focus of this analysis is in the yellow there, that's this week. And then we're also cognizant of our forecast. So we're looking ahead next week, 2 weeks from now, 3 weeks from now, and 4 weeks from now. So let's go through this and see how it works. So starting 4 weeks ago, we had no cash at the beginning, but we generated revenue of $14,000. We had cost of goods sold of $2,800. We had SG&A of $5,400. We had payroll of $500. Just a couple of hourly employees there. That generated a net cash flow of plus $5,600, $5,600, which means we have ending cash of $5,600, and we don't have any line of credit balance is zero. So that $5,600 then goes to the beginning cash of week minus 3. That is, 3 weeks ago, we started the week with $5,600. We generate revenue of $11,000. We have cost of goods sold of $1,000. We have SG&A a little bit higher this week, $8,200, $8,200. Payroll, big payroll week, $19,000. We also got hit with interest, $1,700. So we have a net cash flow of a minus $18,900. Minus $18,900 is our net cash flow. So we wind up with no cash. We spent the $5,600 that we had left over from the previous month, so we covered the rest with our line of credit, which is $13,300 in our line of credit. The next week, we start with no cash at all, but we get revenue of $28,600. We have cost of goods sold, $4,400, SG&A, $3,500, payroll, $7,500. Net cash flow then is plus $13,200, $13,200. We still have no ending cash because we paid off $13,200 to our line of credit. So our line of credit balance now is minus $100. So we still owe the bank $100 on our line of credit. So last week we started out again with no cash, but we generated revenues of $24,300, cost of goods sold $1,300, SG&A fixed costs $2,500, payroll, again big payroll month or week, $19,000. So we have this time a net cash flow of $1,500. So our ending cash after we paid off our line of credit of $100, our ending cash is $1,400, and we have no balance in our line of credit. So this week we start off with $1,400 in the bank. We generate revenues of $19,800, less cost of goods sold $7,500, less SG&A $13,500, less payroll $500. No interest this time. Net cash flow minus $1,700, $1,700. So we have no cash, but we started the week with $1,400, but our net cash flow was minus $1,700, so we wind up with a line of credit balance of $300. So you can follow along in the forecast, and we're forecasting what our cash flows are going to be for each of those categories for the next 4 weeks, so we know where we are. And we see at the end of 4 weeks, we wind up with a little bit of cash, $1,700 in the bank, and a line of credit balance we've fully paid off. So from time to time, some months we go into our line of credit, some months we don't, and we wind up with a little extra cash. This is kind of typical for most businesses, and it varies week to week to week. Now, after we've done the analysis this week and we get into the next week, we maintain the same structure, but we shift all the numbers leftward. So week 4, week minus 4 rather, it kind of goes away, and then all the numbers shift leftward by 1 week. So there's week 4 going away, then the numbers all shift leftward, and then we create a new forecast for 4 weeks from now. So this is the new process that we have to monitor and maintain and plan for our cash flow. This can be a useful tool for everybody. So we hope you'll use something like this. I'm sure most of you try to monitor what your cash flow is going to look like down the road. It's real important to keep track of that so that you don't run out of money. Again, this is the one of the CEO's 3 top jobs is don't run out of money. So money includes not only your cash, but it may also include your line of credit or your credit cards or whatever kind of money you have available. So a budget is a plan in numbers, and a plan is a budget in words. A budget and a plan are the same thing. So if you have a business plan, that business plan describes how you're going to operate your business. If you have a budget, that's also a business plan, but it's expressed in a different language. It uses numbers instead of words. So your plan describes your budget in words. Your budget describes your plan in numbers. They are the same thing. They just use different languages. So I mentioned earlier about the Financial Services Handbook. This is a free download. It's about a 20-page book. It's a free download. It was put together by I put it together at ADOT's request. It addresses all kinds of financing issues, lenders and borrowing, how to do it, SBA loans, all those sorts of things. It talks about insurance, liability insurance, errors and omissions, workers' compensation, health insurance. It talks about bonds, license bonds, performance bonds, and bid bonds. And it's available both in English and in Spanish, and it's free. And there's the link below on how to get it. So I recommend you use the little bit.ly link there, http://finservices. So you have to capitalize the F and capitalize the S in FinServices. but that's the link that you can use to get the Financial Services Handbook for free. So that's all of our substantive content today. I'm open to addressing any questions you might have. So please put your questions in the chat window there at the in the middle of your control screen. So, Mr. Cortez, when will we receive the slides so you can go over it? So we will post that on the ADOT website real soon. The last month's webinar is already on the website. We'll send out an email with a link as soon as we get these videos posted. We should have both the slides and the video posted on the website. Okay, we have another question. We are paid as a sub whenever the client is paid by the owner, and that can take up to 6 months, which is hurting our cash flow as a small business, I'll say. When we call, they said they're not paid yet by the owner. Any advice? Arizona has or most contracts that you engage are pay when paid, and so on that basis, you really can't do anything until that prime contractor gets paid. The prime contractor, though, should have a contract with their customer, the owner, that says that they'll pay in a timely manner, typically 30 days. That can be a problem, I understand, but your prime contractor really needs to be on top of this. The prime contractor is also suffering from cash flow problems as a result of this, and you need to stay on top of that prime contractor. So I don't know what else I can say other than when that prime contractor does get paid, he has 7 business days in which to pay you under Arizona law. So there's a prompt payment from the prime contractor. So you need to talk to that prime contractor and make sure he's on top of his accounts receivable. Make sure that he should be billing twice a month and getting paid then within 30 days. So there shouldn't be anywhere close to 6 months worth of cash flow. If your prime contractor is not really managing his cash flow and that affects you, you might think about a different prime contractor. Yes, those payment terms, I've got a good comment here. Payment terms are in your subcontract. Cross them out. Net 30, no retention. Yes, don't watch out for that retention. Sometimes they want to withhold 10%, but that 10% really represents your profit, and you can't let them get away with that. Go over slide 8 through 11 when time permits. A great break-even point is very important. I just want to make sure I understand. Okay, we can do that. Let's look at the other questions first. Small business and sometimes are prime. We cannot pay before we get paid, or it also hurts our cash flow. Yes, the prime, most contracts, again, it's pay when paid. So the prime contractor is not going to pay you until the prime contractor gets paid. But that prime contractor needs to be on top of his customer or her customer. I know it's a major problem for those of us in construction. Looking at the cash flow form, is that available in QuickBooks? No, it is not. That's something you'd want to build in usually Excel or some other spreadsheet program. Can I use a real-life working example, say a fictitious XYZ company, then let us follow this firm's fictitious business activity as it generates the figures to go on these financial forms, and we can more readily understand the dynamics. So that's a good idea, and in future, we'll try to do that, use one company as a consistent example. Client always asks us not to write or cross anything on the subcontract. Sometimes it does feel like the contract is benefiting one side only. Yes, remember that your contracts are negotiable. And if you want to cross something out on a contract, that's certainly your privilege. You do have to get the agreement of the prime contractor, however, so just having one side cross out a provision does not necessarily mean that provision is not effective if the other side doesn't agree. So when you cross something out, you need to initial in the margin, and both sides need to initial any changes. I'm not going to email the slides, but they should be posted on the internet with the video of the program. Can cash flow planning is a good tracker. How do you analyze it? So I just pretty much keep it on a spreadsheet and update it on a regular basis. We have the exact issue. The problem is we don't know when the prime has billed the client. Yes, you should talk to that prime and find out when they bill the client. You can even request them to put in the contract that they'll bill the client twice a month. That's not unusual, and most clients are used to making that many checks. Often we find out later the prime sat on the invoices and not billed the prime in a timely manner. That's true. You need to get on top of those primes, make sure they are billing their client on a regular basis. It hurts their cash flow too, so they're not managing their business very well. So as a DDE, we have some protection for prompt payment. However, I usually proceed carefully. Yes, you do. Always proceed carefully. Yes, the client sometimes does sit on the pay request, and that's a real problem. And you need to talk to that prime on a regular basis and make sure that the prime is, in fact, billing the client on a regular basis. Twice a month, at least once a month. Twice a month is preferable, because you're not going to get paid until they get paid, and they won't get paid till after they submit an invoice. So stay on top of those guys. So we did have a request to go back over the break-even point. So let's review the P&L. So first of all, we have the cost of goods sold. Those are your variable costs. That's one of the key elements in the break-even analysis. Your gross profit then is your gross sales less your cost of goods sold, and you calculate the gross margin. The gross margin is another key element in the break-even analysis. So gross profit divided by gross sales times 100 to make it a percentage. So that says basically what percentage of every dollar of gross sales goes to my gross profit. And if you're in the construction business, that should probably be somewhere around 40% or more. Somewhere between, say, 35 and 40%. Better than 40% is good for you. So from those gross profits, you then have your contribution, which is the amount of money that you have left over for your selling, general, and administrative expenses. That generates your operating profit and your operating margin. Then you calculate your net profit and your net margin. So the key elements here are your total fixed expenses. That's the sum of your selling, general, and administrative expenses, and your gross margin. So when we get to looking at cash flow, then here's our fixed cost, the SG&A, the total SG&A that we have. This is our variable costs, our COGS. We add the variable costs to the fixed costs. So all that does is raise the variable cost line. So it starts with the fixed costs and goes up from there. And that's our variable plus fixed costs. So the fixed costs can go away. And these are our sales. The more we sell, the more revenue we generate. So our break-even point is where those two lines cross. On the left of that break-even point, we have the operating losses. To the right, we have the operating profits. So we have to get at least to that break-even point before we start covering the fixed costs and covering the variable costs that it took to get to the break-even point. So mathematically, it's the fixed costs divided by the gross margin. So again, we can look at our example. Fixed costs divided by gross margin. So fixed costs are $10,000. The gross margin is $200,000 gross profit divided by gross sales of $500,000 is 40%. So $10,000 divided by 40% is $25,000. That's the break-even. So this is the easiest way I know to calculate the break-even. Mathematically, it works. There are some other methods that sort of take you through multiple steps to get to exactly the same answer, but this does it pretty much in one step. So just add up your selling, general, administrative expenses, all of your fixed costs, and divide it by your gross margin, which is your gross profits divided by your gross sales. So $10,000 divided by 0.4 is $25,000. That's break even. So this company, if they have gross sales of $500,000, then they're pretty darn profitable because they cover their fixed costs and the variable cost to get to those fixed costs at $25,000. So if they're selling $500,000, they're making a lot of money. What SG&A, can you please remind us what SG&A means on fixed costs? Yes, your SG&A are these, backing this up, your SG&A are the selling, general, administrative expenses. Okay, so those are your fixed costs. Now your selling expenses are not maybe exactly fixed because you can decide to cut out your marketing expenses altogether. It's probably not a good idea because in the longer run then your gross sales will probably fall, but those are somewhat discretionary. Your general expenses is your overhead. That's rent, utilities, telephones, those sorts of things, lease on your equipment perhaps. And those general expenses are pretty much fixed. You may be able to negotiate a slower internet in order to reduce your COX bill. You may negotiate a lower rent from your landlord. You may change your cell phone plan to get a cheaper plan. But by and large, those general expenses are fixed month to month. Your administrative expenses, on the other hand, you can decide whether or not to call a lawyer to review a contract or not. You can look at, decide to hire an enrolled agent rather than a CPA to do your books for you or a bookkeeper. So you may have some discretion about those administrative expenses. But by and large, your SG&A are what they call fixed costs. And so the key is to distinguish between what's a fixed cost and what's a variable cost. Okay, well, thank everybody for being here. If there are no more questions, and I don't see any more questions. Show the last animation of slide 9 again. I certainly can. Okay, so here's slide 9, fixed costs, variable costs. You add the variable cost to the fixed costs to generate your variable plus fixed costs. The fixed costs go away, then you have your sales. The break-even point is where those two lines cross. So you have an operating loss on the left and the operating profit on the right. Is that what you needed, I hope? And I see somebody mentioned the one-on-one. We didn't actually mention that, but we do have one-on-one consulting available for those of you who attend these sessions. You can request up to 3 hours of direct one-on-one consultation, free to you. In order to get that one-on-one consulting, you just need to send an email to Kent Lane, describe what kinds of services you need, what your problems are, and he will generally approve those pretty quickly. This is a no muss, no fuss approach. And then we also want to welcome you to our next webinar, May 2nd. We're going to be talking about marketing fundamentals. And you can register today. You can register for all of the webinars in this series at friday-fundamentals.eventbrite.com. So thank you very much. You're welcome to everybody. Thank you all for your very kind words. All right, no one has any additional comments.